So students, this is a very short video for the theoretical part on the international taxation, which I'm putting it right now. Quickly in half an hour, students, whatever the areas primarily which I'm putting it for the international taxation, just you need to restrict yourself only on that. So that way your theoretical portion of the international taxation would also be covered in that scenario. So students, let's start primarily on this particular part. It would be plainly a theory question, students, that will be targeted in the examination. So it would be a completely a theoretical part that will be targeted so far as your examinations are concerned. So now students, over here first is about the one question can be expected on the theoretical part, wherein the treaty between the US model and UN model and the OECD model could be considered. In which very case, students, here first of all, who are the persons who are covered in this case? So the treaty, students, is to be made applicable only to a resident. That is what they say always, only to a resident and a treaty is applicable. There is one concept, students. So treaty, students, if you need to be a resident of one of the country, only then you can invoke the treaty. There is a concept of, students, fiscally transparent entity. Quickly, students, what does it mean? Just like, for example, many country does not treat, say for example, partnership firm as a person. So they don't treat the partnership firm as a person at all at first place. So therefore, on the contrary, the assessment of the firm income is considered as the assessment of the firm income is taxable in the hands of the partner. In the hands of the partner, the assessment has been done. So therefore, partnership firm is a fiscally transparent entity in many of the country. So in that case, the residential status of the firm is not relevant, but the residential status of the partner is what is more relevant in this regard. That is the point. Taxes covered, we know. In fact, I told you through what are the taxes covered, students. Those are the taxes which are taxes on the income. Those are the taxes which are being covered so far as the treaty is concerned. That is the point. Resident. Now, students, over here, so how to decide whether a person is a resident or not? How to decide whether, students, a person is a resident or not? That is something that you will decide on the basis of your domestic tax law. So the domestic tax law would be one that will be considered to decide whether a person can be considered to be a resident or not. Treaty comes into picture only when there is a tie break. Tie break means you are considered as resident of both the countries. So therefore, if you become a resident of both the countries, that's the point of time when you need to refer the treaty. So the tie break is a situation which is referred when you are considered as a resident of both the country. And accordingly, to apply the treaty, you need to determine between the two countries which is the country of resident and which is the country of source. Between the two countries, you need to decide which is the country of resident and which is the country of source. So therefore, the test which is to be considered in the tie-break rules is the following. For an individual where there is a tie-break that happens, the test is you have to follow the test in the sequential order. What is the sequential order? Check out in which country the individual has a permanent home. That country will become the country of resident, and then the other country will become the country of source. But if in both the countries you have got the permanent home, then point number one will fail. Then you go to the second point. Second point is the center of vital interest. What is vital interest? Vital interest is both economic as well as personal. So check out in this case economically in which country he is well off. So that country will become the country of resident and the other country will become the country of source. So that is the center of vital interest, both economic as well as the personal. If economically you earn the income from both the countries, then even this point number 2 will fail, and then you go to point number 3. And what is point number 3? Habitual abode. What is habitual abode? Check out where this particular individual is habitually residing, in which country. So that country will become the country of resident and the other country will become the country of source. But if, say for example, 50% he is residing in this country and then 50% of his time is residing in the other country, then again we don't get the answer. Then we move to the next one, which is the nationality. Check out for which country he is considered to be the nationality of which country. That country will become the country of resident, so that the other country will become the country of source. And the last one, students, is the map. But if dual nationality concept is there and he is national of both the countries, so from this also you don't get the answer about which country is a country of resident and which country is a country of source. So then you go to the last point, number 5, which is the mutual agreement, meaning thereby you will then decide based on the tax authority of both the countries will decide amongst themselves to treat this person to be a person of resident of one country, so that this could be considered as resident of this country and their source country. Now students, be careful in this case. PV, HN, M. Use the mnemonic, students, because this is to be applied in sequence. So PV, HNM. So H&M is a brand. So first is PV, H&M. So therefore just follow the sequence, because this is a sequentially that has to be applied in the tie break rule to decide which country it will be considered to be a country of resident, and therefore the other country will be considered as a country of source. Now permanent establishment is a definition, students, which is generally being targeted. Now permanent, students, establishment, if you see very carefully in this particular case, what is this permanent establishment? As you in this case, students, the word permanent by itself would mean something which is fixed in this case, and that the SSE is allowed to pursue the business primarily through this fixed place. So that particular place will then become a permanent establishment of that particular person. So permanent establishment, students, is important to decide the taxability of business profit. In which country the business profit will be taxable, that will depend upon in which country you have the permanent establishment. On that particular basis, if you have a permanent establishment in the source country and in that source country you have earned the business profit, then the profit which is attributable to the permanent establishment in the source country, that much of the profit would be taxable in the source country. So therefore P, when it is a concept, students, P means what? A fixed place of business. A fixed place of business. So therefore fixed place of business. Fixed place of business from where? From where the non-resident is carrying on its business and profession. That is what is the concept of P. Some of the examples of P has been given in the treaty, which you can just ignore it in this context. Apart from that, students, the definition of P is further expanded to the dependent agent, which we've understood in the case of the business connection. In the business connection also we have discussed the same thing, that a dependent agent P gets triggered, and therefore if you are a dependent agent, in this case if you have a dependent agent in the source country, can we say you have a business connection in India? Answer is yes. Similarly, here also in the treaty, if you have got a dependent agent in the source country, then you are set to have a permanent establishment in the source country. That is a limited point that you should always keep in mind. And another one, students, if that agent habitually plays a principal role which leads to the conclusion of the contract, if the agent habitually plays a principal role which leads to the conclusion of the contract, even in that particular case we can say that there is a situation where the dependent agent who is playing a principal role leading to the conclusion of the contract will give rise to a business connection in India or a permanent establishment in India. So that is also a case of a permanent establishment. Now, deciding the taxation right or allocation of the taxation right between the two countries. So students, over here if you see, the first one is the business profit. So generally the business profit is to be taxed only in the resident country. However, the source country is allowed to tax a business profit if it has a permanent establishment situated in that source country. if it has a permanent establishment situated in the source country, is what the treaty says, both in the UN model as well as in OECD model. As far as the UN model is concerned, students, they go one step further. They go one step further and they introduce this concept of force of attraction rule. Now, this is an important theory that could be targeted. What is this force of attraction rule, students? I'll just give you a quick example. So, example is like this, that supposingly a UK firm has got a branch, say a departmental store in UK has a branch in India. Now, obviously, that branch will give rise to the existence of a PE in India. So whatever is the profit which is attributable to that branch in India, that much of the profit will be taxable in the source country, which is India. But say in this case, even after having a branch in India, some of the buyer in India is directly purchasing the goods from UK itself. Instead of going to the branch, they are placing the order to the UK head office, and from that the goods are being sent to the Indian customer. OECD does not give the right to the source country to tax this income. Which income? The income which arises from a direct sale from the resident country. In spite of having a branch in India, if any buyer from India, if they are purchasing the goods directly from the head office, then the OECD does not give the source country, which is India, the right to tax this portion of income. Whereas UN model, they have introduced this concept of force of attraction rule. As per this, what they say is that the UN model says that the source country, which is India, will be allowed the right to tax this particular income, even this income. So not only they are the UN model allows the taxation of the profit earned from the branch in India, but they also allows the taxation of what? Taxation of a direct purchase made by the buyer from India through placing of an order with the HO. That is what is a force of attraction rule. So force of attraction rule is introduced only in UN model, not in the OECD model. So students, one quick comparison between the two. OECD model, students, as you know, it is mainly for the developed country. The developed country uses the OECD model to negotiate the treaty provision, whereas a developing country prefers the treaty to be entered by virtue of the UN model. Now students, the next particular important article is article number 12, royalty. Be careful, students. As far as the royalty is concerned, it is taxed only in the OECD. In the OECD model, which is for the developed country, the royalty income is taxed only in the country of resident, which means that any treaty which is entered based on the OECD model, in that you will find that the taxation right on the royalty income is exclusively given to the resident country. The source country does not have any right to tax the royalty income. The source country does not have any right to tax the royalty income. But so far as the UN model is concerned, UN model allows the flexibility even to the source country to tax this royalty income which has arisen in their particular country, which has been accrued in that particular country. But what UN model only does is that they provide an upper limit of tax rates. So UN model only will provide an upper limit of tax rates, nothing more on that. So therefore that is what UN model does, but at least it is providing the taxation right to the country from where the royalty income arises, which is not there in the OECD model, because OECD model only talks about the exclusive right of the source country, exclusive right of the resident country to tax the royalty income. So far as FTS is concerned, students, now you will find that there is no article in OECD model as far as FTS is concerned. There is no article so far as OECD is concerned, so far as FTS is concerned. So FTS, as far as OECD model is concerned, it will be taxed only as per the business profit article. So as per the business profit article, the FTS will be taxed. But whereas in the UN model, the FTS has got a separate category, and as per the UN model, what it says, that even the source country from where the FTS income arises, that source country would also be allowed to tax the FTS income, provided there is an upper limit of the rate which the treaty has to provide. That is what it is. So FTS article, OECD does not have any article on FTS. So the taxation of FTS income based on OECD model would be as per article number 7. What is article number 7? The business profit. Based on the business profit, the FTS income will be taxed. Whereas the UN model has a separate article, and they provide the taxation right on the FTS income even to the source country from where this FTS income arises. Capital gains is not that important. Independent personal service students, this is a professional income. This is what, students? The professional income. Now, so far as the professional income is concerned, in this case, again, you will not find any entry in the OECD model. Primarily. So OECD model don't have any entry for the independent personal service, which is a professional income. What they say is that the same article for business profit will be applied to whom? To the independent personal service income. So we have to refer the same article. If any treaty which is based on the OECD model, then we have to go with what, students? We have to go with the article number 7, which is in respect of business profit. But UN model does have what, students? Does have a separate article. What the UN model says, UN model does for the professional income, they have used the concept of fixed base. They don't use the concept of PE. PE, they use it only for PE, permanent establishment. They use it only for business profit. As far as the professional income is concerned, they have used the term fixed base. So if you have got a fixed base in the other country, that is a source country, then the professional income which is attributable to that fixed base, that income could be taxed in the source country. That is what it says. Supposingly you don't have a fixed base, but in the source state, that is a source country, if your stay is for 183 days or above in any 12 months, if you in your source state, if you have got to stay in that state for 183 days or above, then in that situation, students, that income will be taxed. That income will be taxed where? That income, students, will be taxed in the source state. Okay, so that is what it is saying. So now to conclude on this particular part, students, the difference that you can see between the OECD model and the UN model, starting up with the business profit. In the business profit, OECD model does not have the concept of force of attraction rule. UN model has got the concept of force of attraction rule. Second distinction is, as far as a royalty income is concerned, the OECD article exclusively gives the right of taxation only to the country of resident, whereas in the case of the UN model, even the source state is allowed to tax the royalty income. The third point of distinction is the FTS income. No specific article in the OECD model. FTS income will be taxed in the manner in which it is provided in the business profit article, whereas UN model has got a separate entry for FTS. Fourth one, independent personal service. Again, OECD does not have any specific entry. It will be taxed as per business profit, whereas UN model has a specific entry for the independent personal service. And which term that they are using for professional income? They are using the term fixed base, and on the basis of fixed base in the source country, your income, professional income, which is attributable to the source country, that will be taxable. The next particular point, students, is herein method of elimination of double taxation. So that is also a theory question that they have targeted. So which is the method of eliminating the double taxation? There are two methods, students, that is available. One is the exemption method, which India does not follow, and another is a credit method, which India follows. So exemption method, all you know, to give the relief from the double taxation. Exemption method means that foreign income will not be a part of your total income. That's it. So no double taxation. The foreign income which is taxed in the source country, that foreign income will not be a part of the total income of that person in the resident country. So that is exempt in the resident country. So if exemption method is followed, then this is how the double taxation relief is granted. But India does not follow the exemption method. We follow what? The credit method. What we do, we include the foreign income as a part of the total income, calculate tax liability, and from the tax liability we grant the relief. Juridical double taxation, economic double taxation, we have seen, students, in the earlier particular chapter of double taxation. That is it. So that much is what is to require. Now students, there are some past year examination Q&A which I want to quickly run through it, and that much is what you need to know. So UN model, OECD model, that is one which we have discussed it. Second is the past year Q&A. But before I go to past year Q&A, one problem of the students is relating to this chapter, the chapter on BEPS. You don't have to worry anything about it. Students, you only need to recall what you have learned in the domestic law. Like for example, herein the first BEPS action plan which is there is in respect of challenges of digital economy. Now, how India has addressed this particular, the digital economy transaction of sale, purchase, etc. We have addressed this challenge of digital economy by introducing the concept of equalization levy. So the challenge which has arisen in respect of the digital economy or virtual economy, wherein there is an absence of physical presence, that we have addressed by series of provision in the form of equalization levy. So that is what you have to address. So first, what is the challenges? The physical presence is not there. The transaction of sale, purchase, services is undertaken in virtual mode. So therefore it becomes difficult to decide in the digital economy which would be the country of resident and which is the country of source. That is a challenge which occurs. And how the challenge is addressed? The challenge is addressed under the domestic law by introduction of equalization levy. And if depending on the marks, you can just elaborate 165 and 165A. What is 165 in this case? Providing the advertisement service or providing the space for the advertisement service. That is 165, and 165A is about facilitating through an e-commerce platform, facilitating the sale or supply of goods and services. CFC rules, it is not applicable in India, so that's absolutely not required. The BEPS action plan number 4, students, interest deduction and other financial payment. So if the question is asked about what is the action plan in respect of interest deduction and financial payment, then it is the thin capitalization that you have to target, 94B. So if the question is what is the BEPS action plan on interest deduction and other financial payment, it is what? The thin capitalization under 94B is what you have to put across in your answers. That's it. Herein, BEPS action, in this case, countering of the harmful tax practice. So this is also known as nexus approach. Remember students, we have discussed while I was taking you through to the royalty taxation. At that point of time also I discussed with all of you. What was that discussion in the royalty taxation which I had with all of you? I told you the resident who earns the royalty, which royalty? The patent royalty, out of the research that is carried out in India, that royalty income will be taxable under section 115 BBF at the rate of 10%. We discussed that particular point, isn't it? So that is the kind of the provision, because the nexus of this royalty income is with India. The nexus of this royalty income is with India. Why? Because the research activity is carried out in India. How do you say that the research activity is carried out in India? 75% of the expenditure in relation to the research work is incurred in India. 75%. So therefore the nexus is established, and hence the royalty income arising from such particular the royalty income to the resident will be taxed where? In India. And we have a concessional tax rate. We have a concessional tax rate under 115 BBF on such royalty income earned by a resident. What is the rate of tax? 10%. So the nexus is established of the royalty income with whom? With the research which has been carried out in India. This is what is BEPS action plan 5. Thereafter students, action 6, you can ignore it primarily in this particular case. Action number 7 students, I think that is already done. That dependent agent concept that we have discussed habitually playing a principal role which leads to the conclusion of the contract, isn't it? So if a dependent agent is habitually playing a principal role which leads to the conclusion of the contract, will that also create the existence of a PE in India or a business connection in India? And the answer is yes. The third one, students, is the transfer pricing documentation. Now we all know, students, there are three documentation. TP documentation. Which are the three documentation? One is the master file, another is the local file, and third one, students, is the CBC, country by country reporting. Now master file is primarily what? Is telling you the global transfer TP policies. What is the global TP policy? That is what the master file is all about. Local file is a transaction details between the associated enterprise, between the AE. In this context, that is what the local file is all about. And country by country reporting is what is for every country. For every country, students, the reporting is undertaken. Which reporting? The reporting in respect of the entire transfer pricing provisions, which are what are the nature of activity that is carried out in that country. What are the other economic policies which has been adopted by the entities in that particular country? What is the FAR primarily in this case? So every country's reporting in respect of FAR. Students, every country is reporting in respect of FAR. What is FAR? The functions performed in that country, asset which is employed in that country, and the risk which has been assumed in that country. That is what is all about the documentation. Okay, that is it, students. So this is all about the BEPS action plan. And then in this case, students, what I'll be quickly doing it in next 10 minutes, the question and answers. The question and answers that has been targeted in the examinations. So based on that only now you should be getting it. Okay, explain the BEPS and what are its adverse effects. BEPS you already know. Base erosion profit shifting. What is base erosion profit shifting? You are artificially shifting the profit from a high tax jurisdiction to a low tax jurisdiction, and the intention is to avoid the tax. So the BEPS means an artificial attempt to shift the profit from a high tax jurisdiction to a low tax jurisdiction. Now what is the adverse effect? Everyone knows the adverse effect. The government loses its legitimate revenue of tax. In this case, it creates a case of a tax haven. So it promotes the tax haven also, because then in that case it will encourage many countries to keep up lower rate of tax so that the profit gets booked in that country. That will be a harmful tax practices that will be followed across the world. So that's the logic that you apply. What is the adverse effect? That much of it, nothing more. Discuss the 3 tiers of transfer pricing documentation. We already discussed. What is the master file, students? In this case, it is about what? The global business operation and transfer pricing policy. Global business operation and transfer pricing policy. What is the local file? Transaction based information. Transaction based information. That is the local file. And what is CBCR? CBCR is primarily, in this case, the jurisdiction in which they do business, the indicators, the information relating to economic indicators. So therefore, in this context, the CBCR is an annual report of what? Economic indicators of the jurisdiction in which they are doing the business. For each jurisdiction where you are doing the business, you are giving the annual report in respect of your economic indicators. So for CBCR, students, what are you going to write? Annual report. Annual report of what? Of the economic indicators, EI. Economic indicators which are in respect of jurisdiction where you are doing the business. Jurisdiction where the business is carried on. Jurisdiction where the business is carried on. That is what the CBCR is all about. Is that point clear to all of you? Now, BEPS action plan adopted. We just discussed, students, that BEPS action plan number 5, the nexus approach. The nexus approach. So the nexus approach, students, was about what? In this case, the royalty income. I just have discussed with all of you that. So this only just write the theory which has been there in this case. What is the difference between the UN model and OECD model? UN is for developing and OECD is for the developed country. That is what should be sufficient. Now question number 5, students. Examine and state the correctness or otherwise of each of the following statement in the context of international tax treaties. So you need to examine: providing assistance in the collection of fair and legitimate tax. Providing assistance in collection of fair and legitimate tax by the countries involved is the sole objective of tax treaty. Is it this the sole objective of tax collection? No, there are many objectives, which is like allocating the taxing right, avoiding the double taxation, exchange of information, isn't it? So therefore there are other particular objective as well. So tax collection is not the sole objective. That is it. Now students, a protocol. What is protocol, students? Protocol means rule. A protocol is an integral part of tax treaty and has same binding force as the main clause. Protocol is, students, a rule. These rules are, students, annexed or attached at the end of the treaty. Annexed at the end. Rules are attached at the end. Protocol, which is nothing but a rule, are annexed at the end of the treaty. Now this protocol which is annexed at the end of the treaty, students, are generally they are being used for gray areas, generally used for interpretation, for interpretation of the gray area, students. What is gray areas? The difficult areas where we don't have a clear-cut answer. When we don't have a clear-cut answer, refer the protocol, and that protocol will tell you how do we do the interpretation of the same. How do we do the interpretation of the same? So protocol is a rule. They are attached at the end of the treaty. This protocol has to be referred for interpretation purpose in respect of the gray areas. That's it. So that is the point, students. Explain. Now students, these are the 2 points. Now these are the 2 terms, students. Contemporaneo expositio. Contemporaneo expositio means the interpretation through this principle. The interpretation has to be done on the basis of what? On the basis of the meaning. On the basis of the meaning at the time the treaty was concluded. Contemporaneo expositio means the interpretation of the term will be done on the basis of its meaning, which on the basis of the meaning at the time of the treaty when it was concluded, not on today's time. That is contemporaneo expositio. Interpretation on the basis of the meaning at the time when the treaty was concluded. Teleological interpretation, students, it means, students, in this case, in this context, students, here you see object and purpose. Object and purpose. So on the basis of the object and purpose, the interpretation has to be undertaken. Like for example, just now we discussed DTAA. What is the object and purpose of DTAA? I gave you the example. The object and the purpose of DTAA is for avoidance of double taxation, for avoidance of double non-taxation, for tax exchange information, for the collection of taxes, etc. So this object and the purpose is to be kept in mind before you interpret any of the provision of that particular treaty. Keep in mind this object and the purpose to interpret any of the provision of the treaty. This sort of an interpretation where you are doing on the basis of the object and the purpose of that particular treaty, that will be considered as interpretation done on the basis of teleological interpretation. So these are the 2 particular things which is to be considered. That exactly what the point is. Explain the role of, explain with the example the role of protocol. I told you protocol primarily in this case it's nothing but the rule. Primarily in this situation, that is the rule. And preamble. Now students, preambles are given in this context. Like for example, one of the example of preamble which is very popular is the India-Mauritius Treaty, students. If you see the India-Mauritius Treaty, the preamble says that to encourage mutual trade and investment that we are entering into the treaty. To encourage what? The mutual trade between India and Mauritius that we are entering into treaty. So that becomes a preamble. Why we are entering? So preamble gives you why. Preamble gives you what, students? The why. So therefore, in this particular context, preamble in the India-Mauritius Treaty is what? In this context, it is nothing but to encourage what? Encourage the mutual trade and investment in the two. Hybrid mismatch, this question I'm skipping it across it in this context. Now the next one, question number 9. In this situation, what are the approaches for elimination of double taxation under model convention? So approaches, students, which is approaches we discussed just now. What is the approach? Two approach, exemption method. And what is second approach? Tax credit method. And already you know what happens in the exemption method. The income will not be a part of your total income. Tax credit method, it will first be a part of total income, then tax liability calculated, and thereafter from that the credit would be given. Explain the meaning of juridical double taxation, economic double taxation. I have already discussed this particular part in this case. So that is what, students, it is in this particular context. In what context the term thin capitalization is used? So students, thin capitalization means what? Its meaning is that when the debt exceed the equity, and when the SSE, instead of raising the fund through equity, it is raising the debt. It is raising the debt. And why he is raising the debt? What is the reason why he wants to raise the debt? To get the advantage of tax deduction in the form of interest. That is what is known as, students, the thin capitalization in this particular context. And then what is the provision of 94B? You can just write so thin capitalization meaning is when the SSE is raising the fund through debt instead of equity with the intention to get the deduction of interest. That is what is known as thin capitalization. Now, students, this is an important one. There are two types of DTAA made by India with other countries. Limited DTAA and comprehensive DTAA. Explain the term. Now, limited DTAA, students, is India and Pakistan. This is the last question, students. In this case, the limited DTAA, students, if you see, is between India and Pakistan. Now, India and Pakistan, students, why it is limited? Because they have got only two articles. And two articles which covers what, students? One is the meaning and another is the article relating to taxation right on international air transport. That's it. So the limited DTAA, we find it in India-Pakistan DTAA, where we have got a limited entry of what? Only for how to decide the taxation right in respect of international air transport between the two countries. That is it. Only two articles. Treaty is over. Whereas a comprehensive DTAA covers almost all types of income, not only a particular income, but almost all types of income covered by any model convention. That becomes a comprehensive DTAA. Now, what is meant by digital economy? I told you, when the transaction is undertaken through virtual mode and not through the physical mode, such transactions are considered as a digital economy transactions. Okay, and in that particular case, what are the issues that is faced in a digital economy transaction? The issue that you face is the difficulty to identify the country of source and the country of residence. This is the issue that you find in this digital economy. And what are the recommendation? Primarily that you have to follow equalization levy. I told you that the action plan has recommended equalization levy, and on that particular basis the taxation will be determined. Equalization levy is the answer for digital economy. So this is what it is, students. And one more thing, students, that you can write is also on digital economy. Last, students, the digital economy, there are two things to address the digital economy challenges. There are two particular provision that has been introduced. One is the equalization levy, and what is the second one, students? SEP, significant economic presence. Remember that significant economic presence. Economic presence is what will be seen, not your physical presence. That is also to address the challenges faced through the digital economy. So these are the 2 points that you are going to read it, and that is all of it. So students, what we have discussed in this particular context: UN model, OECD model, the difference between the two. Thereafter, students, the BEPS, any case, I told you, don't have to worry anything about it. You just need to focus on what are the challenges and address through what are the provisions which are being made under the income tax law. And the last one, students, the certain terms that we have seen, that much is sufficient, students. All the best to all of you, students. Do well in your examination. Keep your cool and composure, and remember one thing: if the paper is lengthy, if the paper is difficult, it is lengthy and difficult pan-India. Try in that first 15 minutes to select 2 good questions from the descriptive side other than question number 1. Start with that, then you switch on to question number 1, paragraph 1, last paragraph, read that, and then get started with that. And please understand, question number 1, you get the marks on the basis of each adjustment. So don't worry that if some adjustment you don't know or you may go wrong, don't worry. In this case, you will not lose the marks. And then select the MCQs and avoid doing those MCQs which is very long. Integrated case study, which is very big. Avoid them initially and instead jump into solving some other known questions of the descriptive side, and once you are done with that, then you arrive at that both those big MCQs and integrated case study. Small integrated small MCQs and the case studies, you can definitely do it after you are done with the 3 descriptive questions. Which are those 3 descriptive questions? 2 plus 1, 2 other than the question number 1, and then after question number 1 is the third one, and then you switch to the MCQ other than the lengthier one. Then you again come back to the descriptive, which you know the best. Do that properly and then switch on to the remaining part of the integrated case study, which are the lengthier one. Okay. Thank you Aishwarya. Thank you. So students, only one thing, don't do this blunder. One blunder, students, they are doing it just last, students. Question number 2, if you know only one question, say for example, so say you know only B, so A you leave the space, write B whatever you know, and then C leave some space and then move on to the next page for question number 3. Don't write like this, never do this. This is a suicidal. Question number 2A and then question number 3B after that. Never do this. So if you know, say for example, question number 2B, 2A, give some space, B, write that, and thereafter C. Okay, that is all of it, students. All the best. After the examination, do share the question paper with me, and we will not discuss the paper, discussion of the paper after your IDT paper, but do share with me and do let me know how you have felt about it. All the best. God bless to all of you. In fact,